Hey guys, welcome to this week's podcast episode. And I've got a fantastic guest for you today, returning guest, Patrick Grimes. He's from Passive Investing Mastery. He's been on the podcast a couple of years ago talking about real estate. And obviously, the market's a little bit different these days. So, we're going to get into a nuanced discussion about that. And as well as he's divesting into other assets, uncorrelated. We'll talk about asymmetry and risk management in today's very volatile environment. So I'm really excited to have him back on. Patrick, welcome.
Yeah, great to be here, Chris. And glad to hear you made your way to the West Coast and you're not in the heat of and hurricanes in Texas right now.
Yeah, we talk about diversification now. These days with climate change, you have to diversify geographically. That's another topic, and I know you're out in Hawaii as well for brief intro, reintroduction, what you do, and what you're into now, and how the audience can benefit from your expertise.
Sure. Well, we do summer stays in Hawaii, which normally people would do the Malikaliki Maka winter stay in Hawaii. So we're kind of moving into the heat. But anyways, so Patrick Grimes, Passive Investing Mastery. I was a high-tech machine design, automation, and robotics engineer, probably like a lot of your listeners, hardworking, making substantial income, looking for a way to invest it. And it was interesting because I was in the middle of really cool high-tech in the Bay Area where you're sitting now, working for doing projects for Apple, Facebook, Genentech, Johnson & Johnson, Abbott, Lockheed, Raytheon, Boeing. And all these people were just investing in their company stocks, 401k, or startups. So when I went to the manager or the owner of the high-tech firm I worked for, and I said, hey, what are you investing in? I was expecting him to list out like the insider trading of 4 or 5 stocks. He said real estate. I'm like, what? And that was a real surprise to me. And he said, well, his only regret was not buying more sooner. And I got into real estate after that. Lost it all in 2009 and 10 because I went way too big into high risk stuff, didn't know what I was doing, was humbled, came crawling back, and then began building a real estate portfolio, single apartments, about 5,000 apartments as a general partner and operator. And we have a debt fund, an acquisitions fund right now taking advantage of the downturn. And we have non-correlated investments too, which is really why I got into this to begin with. Was I lost it all one time. How do I invest to keep all my eggs in not one market, all in one cyclic market basket? And so that's right now I'm very interested in trying to get into true diversification of my portfolio by allocating into various markets that won't be up and down all at the same time.
Yeah. I love that. And definitely real estate, it was like a good time, after the great financial crisis all the way up to like 2018, and now it's kind of like it's harder and harder to find better deals because everybody's into it now. And we could take this conversation a couple of ways. And first thing is, so when you talk about uncorrelated, I know a lot of the audience is like they don't understand that, or they haven't really applied that idea. So what does it term uncorrelated mean when it comes to asset allocation?
Right. Well, so in essence, it just means that various investments or various markets are driven by different fundamentals. And those fundamentals will drive them upwards and drive them downwards. And capitalist economy kind of relies on it, there's these cycles. Just happens to be that things like the stock market don't ride on the same cycles oftentimes as real estate. Sometimes they do, like in 2009 and 10, when I lost everything because the only 2 things I was in fell apart. And maybe it will again. Right now, real estate is down, and we just finished a Fed rate hike, and 11 out of the last 14 Fed rate hikes ended in a crash. So if you're in real estate and stocks right now, you may be thinking, well, shoot, those could be down. Maybe they're non-correlated, but sometimes those markets do fall. So maybe you want to be in something else. Good examples of non-correlation that are easy to understand is just gold and the US dollar. If you look at any of the decks, and we have a mastery series that we have, show that gold trends inversely to the US dollar. That would be called negative correlation, and opposite correlation, inverse correlation, or you said asymmetry. There's a lot of things. But it's interesting, and the same thing with the stock market. Historically, it mostly trends. Now, for the last 2 years, you've seen gold and the stock market grow, which is sometimes there's unique things. Oil and gas doesn't trend, right, with the stock market, doesn't trend with real estate, but it does trend with gold 80% of the time. So it just happens to be that, gold and also oil and gas fundamentally have a heavy influence on the BRICS nations, and those tend to drive both of those safe haven investments. So people will invest part of their cash in gold, and keep a balance and also hedge against their portfolio. Maybe in real estate is an allocation. Most of the wealthy have like 26% in real estate. But where do you go beyond that? And there's other investments that are not as well known, which even have more stability than the more well-known markets, and that provide completely non-correlated returns that have nothing to do with the rest of your portfolio. That's our diversified litigation portfolio is one of those, right? And they're highly coveted for exactly that reason. It's non-correlation to broader markets.
Yeah. Yeah, I love that. I love that analogy of uncorrelated. Is basically when one thing is down, you have something that's up. So there's a lot of different strategies. There's that you talk about gold, dollar. Sometimes there's a hedging using options. A lot of different things. So kind of one thing that you mentioned asset classes. And one thing that's been on my mind is this, I don't know if you have any experience, but a lot of people are turning to digital assets, because most notably Bitcoin, because it's actually a very nascent, legitimate asset class. And so a lot of people are doing that because the government's printing, trillions of dollars, starting wars, sanctions, all of this. So I don't know if you have thoughts on Bitcoin and like kind of the age difference. I know the boomers hate it, and the Gen Z millennials are like, yeah, I'm not gonna touch gold because it's so heavy and it's very inefficient. But Bitcoin I can carry around, So what are your thoughts?
Well, for the record, of gold, I keep it in. There's depositories, private vaults around the country. You can just stash it. You don't have to lug it around. I'm not a fan of buying electronic ETFs in gold. I'm also not really a fan of crypto. I do have crypto. And I'm doing really well with crypto, but I'm not proud of that, because nobody should be proud of but it's amazing. It's really incredible, but it could vaporize tomorrow. Really, fundamentally, it's not something to be proud of or excited about. Yeah. It's just a game you're playing, and there really isn't any intrinsic value behind that. Now, the crypto I do own is in cold storage, which means I actually identify its location on the blockchain. And if a company that you bought it on, where if your wallet's with them, it could vaporize overnight. It's not my case. So if you do own it, you got to own it right. And cold storage also provides that long term. So the only reason I would have crypto is essentially to have a stash of almost like a doomsday supply of another allocation. It's not really a part of my investing portfolio. It's just a way to access cash. I'm heavily in Chase, right? I'm a partner in over 20 different securities offerings, and most of the accounts are in Chase. If Chase locked up, most of my finances would be locked up. Where would I go? Gold, crypto, right? And has that happened? Maybe. I don't know. Like, for how long do I want to be out without cash? So that's really why I'm doing crypto. It's not something, like I said, as that's a true part of my strategy. But we have a passive investing mastery series where every 2 weeks I have different kinds of alt assets, all kinds of experts and sponsors. And we have another crypto guy coming up. We have a blockchain guy, and I'll get on and duel with them for a while. And I appreciate where they're coming from and how well they're doing. Not my jam as a true investment in an allocation in my portfolio.
Yeah. I like how you describe it. It's kind of like you're thinking like a venture capitalist is just kind of like having some exposure to it, like just allocate like 1%. I mean, now people are saying, allocate 5%, because the original 60-40 stock bond doesn't really work now. So I like how you're thinking like a VC, and just basically you have upside exposure, and if you lose it all, it's just like 1%, you can always recover. Which brings me to my next question about real estate, because I've been doing a lot of thinking, and I was like, I was like you before. I was like, yeah, I'm gonna be 100% real estate, and luckily I didn't do that. I was like 50-50, just kind of hedge because I was like, what do you do if you have like a hurricane barrel or and now these days, I'm like, you don't make much money in real estate. It's like painful. You got hurricane, tornado, fires. You have tenants that have more rights than you do. You got just outrageous prices. The insurance premiums. Like it's not, and they're saying it's passive income. It's not. It's not passive. It's a really pain in the ass. So you mentioned 25 to 26%, of the wealthy. What is their thinking like? Is it just kind of like a store of wealth? Like, because I know people are just buying these outright and just leaving it empty. What are your thoughts?
Well, it's interesting. I'll give you a few different data points out there. Even Morgan Stanley, whom I would consider be somebody I wouldn't trust for investing advice, even they caved recently, and their global investments group said you need to have a 25% in alternatives. 25%. Now, if you look at some of the charts that show below 500,000 in income a year to $1 million in a year to plus, what you find is like the lower income producers have about 7% in alternatives, right? That and real estate is just an alternative. It's always been an allocation for me to de-risk and diversify. It's not the end game, it's a step. And it quickly can come out of balance, and it can become an over-allocation and a danger and a threat to your portfolio, which is what you're alluding to now, right?
Yeah.
So 25% alts. So if you go back to like the below 500K, about 7-8%, then 500 to, I think it might have been 2 million, something like that, 5 million. I can't remember exact numbers, but it was actually 25% in alt. So that's really, I think, but then once you get to the ultra wealthy, they're above, 10 million. These individuals have 50% of their wealth in alternatives. Now that's alternatives, including business equities, right?
Yeah.
And so if you want to start allocating in a way in which you can earn and you can earn your income, you can invest it in a way where you get to keep it. You can't put it into something that rises and falls all at the same time. And so those allocations, the 13% they have in cash and cash equivalents, you got to allocate some of that into gold, right? You got to allocate. Then when it comes to your real estate portfolio, you can't get indexed above that 26% mark, right? Because you have to get another 25% in other things. Now you have commodities, fixed income. So maybe you can invest in our income fund, which is a real estate asset-backed debt. So maybe get a little real estate and you're like 7% allocation for fixed income. That works, right? And then there's a commodities, there's really like 3%. You're talking like oil and gas, right? And people always think, well, maybe I'm an oil and gas guy. Well, that's a really volatile. I mean, we've done a lot in oil and gas. In fact, on both the working interest and my family collects on royalties, I'm not relying on it because I've seen it do this, right? I mean, we've this 3 generations of our family collecting this huge roller coaster of income, that is through oil and gas, royalties. That's just an allocation. Investors like yourselves, that are high income earners, sometimes think, oh, the intangible drilling costs. It's amazing, but it is. But sure, you got to be ready to lose it all, just like Bitcoin. Where you go with that 25% that is not real estate, that's not in the commodities, hedge funds, fixed income, cash equivalent, right? What do you do with that? That is where you have to find the lesser well-known alternatives. And to those, you got to look into the markets that are recession resilient. Utilities, people go to utilities, education, healthcare, love healthcare. We do legal services. Legal services is the steady, tried and true. Just you see all the other markets dance around it and it just grows, right? I mean, both sides. And there's argument that legal services is even counter-cyclical because people get more litigious in downturns, but really it's just flat. So that's why our litigation portfolio helps add that extra thing to it, right?
Yeah. You mentioned what I'm curious is what your litigation services portfolio, is that investing in big companies that represent, talk about that and how you're allocating and how you evaluate it just on a very surface level.
Yeah, well, the challenge is once you find these markets that are just super steady, non-correlated, right? And you're, okay, how do I invest in it? How do I get access to that stability, that market cycle, to allocate my portfolio in a more resilient way? And it's tough, right? It's tough to access education. Healthcare, there's quite a few ways you can access it. Legal services, it's so simple. You've got hourly rates and court fees and legal fees, right? So there's not a lot of things, except for what you realize is that the industry runs on hourly rates and their customers can't always pay that. And that happens to be the case when there is a mass amount of people harmed by some corporate misconduct. And in those cases, in order for those individuals to have justice, the attorney's got to work on contingency or pro bono, which is free, that's not how the economy runs, but they got to work on contingency to be paid on the back end. And so there are like Camp Lejeune, for example, the DOJ fed contaminated water to our military. And for 17 years, they knew it was happening and didn't do anything. And now there's been legislation passed saying they're going to pay for damages. There's a grid published saying what their settlement values are going to be. And we can support these attorneys by lending to them and providing the resources they need to pay for their own hourly rates and to help market to find new individuals to then reach those settlements. And then we can participate in the contingency fee position. And Roundup is another one where Monsanto, unfortunately, farmers overexposed now have cancer, and firefighter foam. Civilian military firefighters using this 3M foam, and the heroes of our society and our nation are suffering from things like non-Hodgkin's lymphoma. I mean, there's legislation right now passed to give $1 million to us. It's horrible. And these people knew about the cancer causing in the 70s of the PFAS forever chemicals. So these are just horrific things that we're holding, people accountable for, and our investors get to participate in really great returns. We do good, and we provide meaningful settlements to the claimants, to the harmed, and that's how we access it.
Oh, interesting. And so your investments in these funds, are they publicly traded companies, or they're just privately held? Or I'm just curious.
Well, if they were publicly traded, we'd be back into the sentiment-driven stock market, right? And so that's why I don't like trying to get correlation by just investing in a hedge fund or something, or publicly traded, non-correlated stock, because you're back into the same. It's basically what financial planners do. Hey, we'll diversify you into real estate and put you in this REIT. By the way, REITs track exactly with the S&P 500, right? So you gotta think private. And in order to get true non-correlation, you've got to get into these private placements. You've got to get into the real asset. And so, no, we are originating loans through our fund directly to attorneys. Okay. And the loans are traditional kind of loans, but the asset, the borrower is an operator and an attorney, not an operator in real estate, right?
Yeah.
We're benefiting claimants, harmed people, instead of housing tenants, right? And our returns on principal interest payments, they're actually equity-like returns with preferred returns of capital and waterfall upside. So it's very similar to the real estate space. And our debt fund, we're originating loans to operators, but a completely different asset class.
Interesting. Yeah, I love talking about this area of risk management, portfolio, asset allocation, and correlation, uncorrelation. If people wanted to reach out to you and talk with you, dissect your ideas, how could they do that?
Well, so passiveinvestingmastery.com. It's a lot. Type in passiveinvestingmastery.com. We should get one of those cute little short things to make it easier. One of the things that I love to do is talk to people, and wherever you're at, and I have ridden I got out, but I rode the wave of corporate America for a long time. I'm happy to chat with anybody, get them pointed in the right direction. I actually can give away a book too, if that's all right.
Absolutely.
So Persistence, Pivots, and Game Changers. That's the book, Turning Challenges and Opportunities. I wrote a chapter in it right here. I still had hair, and it all fell out during COVID. So my wife cut it all off. But anyways, Phil Collin, lead guitarist of Def Leppard, did a chapter in here, NFL, NBA players. It was so cool. Entrepreneurs, artists. It was so cool. It's such an amazing group of people. But I tell my whole story, right? The journey in and out, losing it all, coming back, high tech, got out, all that stuff. And if it inspires anybody along the way, that's enough for me. So we actually ship out signed hard copies. I sign them. Go to passiveinvestingmastery.com, and the secret link is /book. Okay, passiveinvestingmastery.com/book. Go to that website. Make sure you put Christopher's name in here, or the name of the podcast, so we know who you are. We don't just ship it to randoms. We'll get a copy of that out. But if you're interested in non-correlated investments, help round out your portfolio in a very precarious time right now. We're in a boom in the stock market. Probabilistically, those rate hikes have ended in a bust. So if it's any time to invest in true diversification, this is it. Happy to get you on that path. We have various investments on our site.
Yeah, awesome. And I love talking, and for all the audience, be sure to check out that Passive Investing Mastery. Follow all of Patrick's socials. And with that, thanks so much for coming on.
Appreciate it. Glad to be